Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me David Jensen. David's been with me most often on the second hour of this show, but we've moved him up here to the first hour because I want a lot of you to hear what David has to say, and it seemed to work very well, his views and what he talks about with John Rubino, who will be joining us at about half past the hour, the first hour of today's show. David is a professional engineer, and he holds a law degree and an MBA, and he has worked as an engineer in the aerospace industry, and his MBA was really focused on logistics and supply chain management. I think very important discipline that David brings into the equation. Realizing that the establishment is using Keynesian economics to lead the masses astray, David really discovered free market Austrian economics, and that really sort of changed his focus on the world and how he views things, and certainly what he has to tell us today. But he has a very practical application for his views as well, given his experience as an engineer and in the mining industry. He also was a vice president of corporate development at Western Copper Corp, and most recently was the president and chief operating officer of Skyline Gold. David currently heads up a private mining company, but I really do enjoy having him on the show on a regular basis because of what he brings, the big picture view of the world, his worldview, I think, which is spot on, very accurate with mine, and as an Austrian advocate of Austrian economics, free market economics, as opposed to the interference in the economy and in markets, and the interference in our lives, quite frankly, that is taking away our liberty and our freedom. So that's really the commonality that David and I share. And so welcome, David. I'm really glad to have you with me again.
Good morning, Jay.
Really, always good to talk to you. And I first want to, you and I were talking a little bit earlier today about the lack of economic growth. Now, certainly not the picture I get when I turn on CNBC. I think it was the fellow from Goldman Sachs this morning was talking about how we're actually doing pretty good and how the United States is really the engine that's pulling the rest of the world and helping to pull the rest of the world out of its mire and its muck. But I don't think that you see it that way. Can you tell us to what extent you think the U.S. is enjoying any kind of economic recovery at all? Do you buy that?
It depends what your measures are. If you look at real inflation as measured by the Bureau of Labor Statistics historically, the growth that's supposed to be there is basically in inflated dollars. In real terms, if we look at actual growth of real productive output, we are not seeing growth. But even using the numbers that the BLS produces today, the Goldman Sachs index of leading indicators is showing a return to a slowdown in the economy and heading towards a recession again. So I don't know where Goldman Sachs gets that from, but we're seeing also guidance. Earnings guidance now has been reduced by about 50% for the coming quarter. So, I'm not seeing the growth and the acceleration out there. There's some modest growth if you use the distorted measures of the BLS, which underestimates inflation. But in real terms, no, I don't see the growth up there, Jay.
Yeah, it's really, I'm with you on that, and certainly use John Williams' numbers of what is really costing to keep a family of four alive, and it certainly doesn't seem to be there either. But in any event, I want to focus on why you think that is true. And you and I were talking earlier today, and you sort of refreshed my memory on the importance of price discovery in the capital markets. David Stockman has talked about this very eloquently on this show and elsewhere as well. Tell our listeners why it's important for the interest rates to go to some free market level as opposed to some dictated level by the gods of the Federal Reserve.
Yeah, well, especially in a time that we're in right now, where we're coming on the heels of a credit binge and a bubble economy. The economy globally is really saturated with debt, and what higher interest rates do is that they clear excess debt from the economy, first of all. And then secondly, with higher interest rates, only the highly productive enterprises can pass that higher interest rate hurdle. And, the Austrian school really focuses on this in terms of what they call time preference. But higher interest rates focus the economy and the economy's productive output on enterprise that can give a near-term adequate return. If you have low interest rates, everything gets financed, and some things that may not produce anything for 10 years if you're running essentially negative interest rates, which we are right now in real terms, they just go on, and you don't get that stimulus to the economy from new real enterprise. You just continue to finance old, malstructured, and speculative enterprise.
Mm-hmm. So you have malinvestment, and what you're really doing is encouraging capital to flow into non-productive areas, or areas that are less productive than they would flow into if they were given higher rates. If capital, so if I'm sitting with excess cash, I have some savings and I have some capital, I'm encouraged to go for the highest risk, not the highest return relative to risk that suits my preference, of course, over time. And what you're saying is the distortion of the interest rate markets and the suppression of interest rates is not allowing that efficient flow of capital to take place, right?
Yeah, and industry as well is not compelled to focus on only those developments which give a high rate of return. So everything gets financed, speculative and unproductive enterprise as well as the valuable things. And higher interest rates bring a discipline to the market and focus the attention of everybody on those things that can only meet the highest standards.
Right, and you mentioned time preference of money, so we're really looking at the present value. So if I'm looking at a mining company, I'd like to see that company get its cash flow early on in the project. So you're looking for the time value of money is a very important concept here too, isn't it? Yes,
it is, and it's really being short-circuited with low interest rates.
Okay, so the conventional wisdom, though, the Keynesian model suggests that what we really need to do is to get demand going. We need to have excessive amounts of government spending. We need to run big deficits. We need to have easy money, and so those deficits can be financed. We want to have low interest rates so that people will go out and borrow and buy houses and buy cars and other consumer items. Why doesn't that work?
Well, we've just been through that period now for the last several decades, and the Wall Street Journal in 2013 estimated that global debt was about $223 trillion, or 313% of the global GDP. So we've been through that credit binge, and the problem that we have now with 313% plus of GDP plus outstanding debt is the fact that historically the balance point or the equilibrium point for carrying debt globally has typically been about 150% of GDP. So what we have now is more than double the stable rate of indebtedness globally, and it leaves us with about $115 trillion measured in 2013 of excess debt globally, and about $32 trillion in the United States of excess outstanding debt. And that is a burden on the economy, and it really needs to be cleared so that the economy can function once again. And this is what is dragging us down. It's what dragged Japan down. And they've gone through this easy money cycle and printing of money, and it does not work. It does not solve the problem. The problem is the outstanding debt. It needs to be cleared, and interest rates have to be able to rise to refocus the economy once again.
It doesn't solve the problem, but it certainly would if we were to allow the markets to go back to where they should be, the free markets, which never should have been interfered with to start with. It would, though, you would agree, I think, be a very painful process.
Well, the major obstacle is the too big to fail banks. They're levered about 15 to 1. And if you have to clear out $30 trillion of excess debt in the U.S. And $114 trillion globally, what it's going to do is going to impact the balance sheet of the too big to fail banks. And with this 15 to 1 leverage that's in the banks, they just need to lose a fraction of the outstanding value of their assets, and they're basically gone. So what we're saying here is that if we had to have an organized write-down of the global debt, that there would have to be a restructuring of the banking sector, and basically the too big to fail banks who really control things currently would basically become historical artifacts.
Yeah. You and I understand very well, but I think most people, even Peter Treadway, who I talked to in the second hour of today's show, I don't believe really understand it. Peter's really a great guy. He's a mainstream economist, a monetarist essentially. But basically, the notion that there is some relationship of gold to the capital markets is not something that most people think of, including well-trained PhD economists from Princeton, Harvard, and Yale. Now, Larry Summers, though, understood it. There's a connection. Alan Greenspan, first of all, understood that in order to have a command economy, in order to have a socialist or fascist economy that's run by government, not by the people, that essentially you had to suppress the price of gold. But Larry Summers understood very well that the price of gold needed to be suppressed in order, if you were going to try to stimulate the economy with interest rates, with low interest rates. Can you explain that connection for our listeners?
Yeah, well, Larry Summers wrote a paper in the late 1980s, I think 1988, along with a cohort named Barsky, regarding Gibson's paradox. And it was Gibson's paradox was a market artifact which had been observed over centuries, and it really led to the understanding that what happens is that with rising gold prices, you ultimately have rising interest rates. So what people are doing when they're buying into gold is, with a fiat currency, is they're buying gold and selling dollars. And they would also then be selling bonds if they didn't want to hold dollars if the interest rates weren't high enough. So to attract individuals out of gold back into bonds again, into the debt markets, interest rates have to rise. So that's about as distilled a description as I can give. But basically, Gibson's paradox says rising gold prices are associated with rising interest rates. And, there seems to be an understanding of that in the capital markets because, from Dmitry Speck's work, we can see that in the early 1990s, statistically, there was a deviation of the trading in the COMEX with the price of gold in other markets. And although even before this, in the late 1980s, we did have the introduction of unallocated gold in London, which allowed them to basically create virtual gold as well. But it was really the combination of the virtual gold trading in London, which is 85% of the global gold trade, along with the trading, the structured trading on the COMEX, which we could see there was a deviation and a drill down in the gold price every day when the COMEX would start up.
Mm-hmm. So you talk to me frequently about the disconnect between the physical markets and a newly, really a rising physical market exchange for gold and silver and platinum and palladium in Shanghai. For those of us, the people that listen to the first hour of this show, and if those that might not listen to the second hour, maybe go over a little bit the statistics. I believe something like 100 to 1 in terms of paper gold to real gold gets traded on the LMBA and in New York. Is that right?
Yeah, the London market trades about 200 million ounces a day on average on a monthly basis currently. And that's about 600 times the daily gold production worldwide from all the world's gold mines.
Wow.
So with that tremendous ratio, it's visible that they're not actually trading gold, but they're trading these unallocated or virtual gold instruments, which are... Mm-hmm. People say they're 100 to 1 ratio to gold, to physical gold, but in reality, they're just virtual instruments that are trading, that are really the lion's share of the gold trading out there. And so when you have this tremendous supply of virtual gold to the market, you're essentially fixing the price for the Western investors who are price followers. Mm-hmm. In the East, where they just want the physical metal, they just buy hand over fist. And so what we're seeing is between the LBMA and the COMEX trading virtual gold, and containing the price with a form of price control, that the inventory is being swept off the global stage from the West to other points in Switzerland and into Asia as well, where the physical metal itself is valued. And that's the real problem that we have today, is that the price cannot bring proper gold price discovery to the markets. And as a consequence, ultimately, we know with price controls that we're going to have empty shelves, and that appears to be coming now especially with the new Chinese Shanghai Free Trade Zone gold exchange opening up. The Chinese consumption of gold is estimated over 3,000 tons a year when you include the estimate of what the government is buying, and that compares to a global mine production of about 2,800 tons a year. So they're over the world's gold production on an annual basis. in Chinese consumption alone. And there's India and Switzerland and all the other markets as well that are consuming the metal.
Yeah, well, so what do you say to mainstream economists, mainstream people, most of the masses of people who say, so what? We've got the dollar. Who cares?
Yeah.
Who needs gold? I mean, to most people, including my friend Dr. Peter Treadway, he doesn't see the connection.
Yeah.
Why does this matter? Why are we harping about this on this show? Why do you think it's important?
Well, it matters because of how distorted the credit markets become, because you basically shut off the warning indicator, which gold is, and it's a prevention mechanism which stops excess credit from being created. Now we have this global $220 trillion of outstanding debt, and we can see the impact it's having globally on the markets. And it's been announced today that QE won't be effective for Europe. We've seen it hasn't been effective in the United States except to drive the market values up in the stock market, but it does nothing for the economy. And we can see what this money printing has done in Japan, basically with a quite a strong downturn now in the GDP in Japan, and we're seeing a rapid devaluation in the Japanese currency as well. So it has only bad consequences. It satiates the banks and helps to buoy their balance sheets for a period, but it has a terrible impact on the real economy and on the citizens of our countries.
Yeah, so maybe we just sort of sum up here what we've talked about, the importance and the reason it should matter to the PhD economists from Princeton, Harvard, and Yale is that by suppressing the gold price, you are enabling endless amounts of credit to be issued, which is then leading to malinvestment, which means that savings is going into areas and capital is flowing into areas that don't produce the cash flows to service the debt from which that money was manufactured. And so what we really need to do is let the gold price go where it will go, where the natural market forces would take it, which would force the interest rates to some level. Do I have that right?
Yes. I mean, you have a distorted economy, and then on top of the distorted economy, you have the twin sister of it, which is government deficit spending. And when you have those two together, the economy is malfunctioning, and the governments respond by printing money, and it leads in the end to basically debt market collapse and ultimately, when the debt market collapses, it impacts the economy and leads ultimately to a breakdown in the value of the fiat currency, which is being utilized in the economy.
Okay, so we have a brilliant economist, unfortunately no longer with us, named John Exter.
Yes.
I met the man once in my life at a coat check at a conference. I'm sorry I didn't learn to know him more, but he was brilliant. He was a Federal Reserve economist, member of the Council of Foreign Relations of all institutions. He was also a Harvard economist. He also was in charge of the U.S. gold supply, and he was very much a deflationist. He saw all of this stuff that's going on as deflationary, all the debt because it could not be repaid. But John also saw gold would rise to extraordinary levels in real terms. Can you talk to us a little bit about John Exter and how he how he foresaw what is going on now? I can't imagine he could have ever believed that we would go to trillions and trillions of dollars of excess money creation as we have without all hell breaking loose first. But Exter really believed that ultimately this game could not keep up and that the system would collapse, implode, if you will, into a deflationary implosion. But he saw that gold prices would rise to enormously high levels, did he not?
Yes, he has the what we call Exter's pyramid, and it's really an inverted pyramid of assets. And at the bottom is gold, and above that is currency, and above that is our treasury notes, and then we get into more speculative things like equities and real estate. And at the very top, at the most imbalanced point of the inverted pyramid, there are derivatives. So John Exter warned us that basically decoupling the currency, and he warned Paul Volcker, directly that this was going to lead to currency failure, decoupling the monetary system from gold because of the excess creation of money and debt. So what happens in the end is that the enormous overhang of debt in the economy and the malstructured economy start to weigh down, and it starts to lead to a deflationary crash as all of these assets underperform. And there's a migration down through the pyramid from the widest point of derivatives down through equities, and the migration continues down through treasuries and then into cash, and then finally at the bottom there's gold. So we would expect to see rising interest rates at some point as the economies continue to underperform with the loose monetary policy which is being run, and then a concern about the bond market and moving into cash, then a rapid increase in the value of gold. And the problem that we have, maybe in closing out, Jay, is the fact that the markets, the gold markets, are not gold markets themselves. There's estimated 1% of the gold in them versus the open positions. And there's going to be an inability to move in a coherent manner, an ordered manner into the gold that is there for all the positions that are there, even now in the best of times. When there's a mass movement into gold, it's going to create basically a market dysfunction. And that's why we really need to have a structured restructuring of the debt market and a revaluation of gold before the gold markets are depleted and the economies and the credit markets seize up themselves.
Well, we can hope for that. I don't know what the chances are. I don't think they're very good, honestly, because I don't think that the powers that be, and you mentioned Paul Volcker, he had other masters that he served who weren't very much interested in gold. Those masters wanted to retain their legalized right of counterfeiting money. And so the whole notion of allowing gold to become money again is really enemy number one as far as they're concerned. So my fear is that this thing is going to go until it collapses, and then, of course, there could be an awful lot of other issues in society that would come to play. But I want to thank you very much, David, for your insights.